Welcome to the first module of this series of short videos that will explain, at a conceptual level, commodities trading and analytics. My name is Phil Cote, and in these first modules on the basics of commodity markets, we will cover a number of aspects that are fairly important, primarily from an economic standpoint. First, we will cover economic principles, that is, what underscores price movements. We will do so in the context of supply and demand, and how the combination of supply and demand impacts the marginal market price. Then we will move to the pricing dynamics. The pricing dynamics refers to the movement of prices over time or the co-movement across specific commodities. Risk and uncertainty is how we assess risk in a trade. And finally, we will cover a very important principle, that of spot to forward pricing. So this explains the boundaries of price movements as of a given day for different delivery times. Now, why does this matter overall? It is critical to establish a framework through which we can understand the transmission mechanism in a given market and establish a forward market view. The transmission mechanism reflects the process through which changes in supply and demand will eventually impact the price in the marketplace. First, let's discuss economic principles. The first principle is around the price-setting mechanism. The marginal molecule always sets the market price. So what we have demonstrated in this graph here is a supply-demand model. The blue line represents demand, and the red line represents supply. At a given intersection, where the intersect would actually be the marginal market price. So what we have in this case is a simplified model of global oil supply-demand balances pre-COVID-19. So roughly it was at $60 per barrel, where the horizontal black dotted line is. And as an example, what I have overlaid to it in the blue dotted line would be after a demand shock, the price would set a new equilibrium, in that case below $50 per barrel. As you know, market prices went lower. But this principle is important. The marginal molecule, it is not the average level of demand or average supply available. It is the marginal molecule of demand and marginal molecule of supply which sets the market price. Another important principle along those lines is in looking at price differences between different locations. The only thing that matters in the short run are variable costs of moving or transporting from one location to another. So if you think about it, commodities will move or migrate from one location to another when the price difference after variable cost or marginal cost is enough to cover those transportation costs. The second aspect on economic principles is to form an assessment to what degree markets are perfect or imperfect. Now, what do we mean by a perfect market? In economic and finance theory, when we refer to perfect markets, we refer to markets where there is a multitude of suppliers and a multitude of end users, where no specific agent, producers, or end users have any undue influence or control on the market. We also think about markets where all information that is relevant to price formation is disseminated to all at the same time and without cost. And it goes so on. There are many more assumptions. Now, in reality, not every market fit those assumptions. So what is important at our end is to form an opinion around what the implications are if markets are imperfect. So examples of imperfections might be where there are government preferences in some markets. An example would be supply independence for energy commodities. If a country forms a policy of supply independence, it may mean a different form of legislation or support on production, trade barriers, so reduction on export or export bans. It may be controls on imports, or there might be quotas as well. So quotas, sanctions, tariffs would all be example of those. Economic sanctions would be another example. And in the world of oil, the best example would be OPEC. OPEC is effectively a managed supply organization and forms a large proportion of global supply of oil. Therefore, the coordination of supply amongst those agents will result in different market behavior, as if we were in a market that is pluralistic with multiple suppliers where no one has effective control of supply. In this slides, we'll cover at a very high level what actually occurred with COVID-19 pertaining to oil balances. So this information comes from the EIA in the United States, and we are currently in October 2021, so all information prior to this day is actual data, and all information forward from this day are forecast from the EIA. So what we have here is the red line represents demand, so roughly 100 million barrels a day prior to COVID-19, and we saw a rapid decline in demand. So as people stopped traveling, jet fuel demand reduced very rapidly. Then people had to stay home, work from home, gasoline demand, and obviously diesel transportation was also impacted. So what we saw is an extremely rapid decline in demand that was not immediately followed by an appropriate reduction in supply. That opened a gap, a market that was oversupplied. And the impact of this is because they are physical commodities, they need to be stored, if not consumed. So what we have in the black line represents the implied storage level pertaining to the gap between supply and demand. So what caused prices to go much lower and negative was the combination of a rapid demand destruction, the lack of immediate response in supply declining, which forced the excess supply into storage. And because storage is fixed capacity, if supply does not readjust and realign with demand quickly, at some point in time, the price is the market mechanism that will force suppliers from stopping to produce. So what we saw here is effectively OPEC through a managed cut to try to establish supply and demand. Which leads me to physicality. Physical commodities exhibit very complex supply chains. And an important aspect of this is complexity generates disruptions. And also perishability impacts the pricing dynamics. If we compare precious metals like gold versus dairy product, there is an impact on how long it can be stored and still be consumable or worth something. So what we have here is a generic commodity supply chain. It is very important in any market to have a thorough understanding of the full supply chain. Only a full understanding of the supply chain will result in proper understanding of the pricing dynamics. So what causes volatility in a market? So any of those assets, because they are physical assets, whether we're talking about oil, agriculture, metals, whether they are base metals or precious metals, any single potential weak point or choke point in a supply chain will eventually have unplanned activities. The last point, which is very important, is how to establish the market value of a commodity. What do you need to know to establish the market value? There are three important things. The value can only be assessed in the context of understanding the grade of a commodity. So in the case of crude oil, it would refer to specific specs on it. It might be in the case of, for example, agriculture. It might be different types of wheat or different types of corn. And of course, if you're looking at aluminum or other metals, it might be the grade. The other part that is very important is delivery timing. So the price can only be assessed if we know whether it is for immediate delivery or delivery at some point in the future. Those will reflect different combinations of supply demand. And obviously that will be reflected in a different price point. And also the location. Having a commodity at a given location does not mean it will trade at the same price as another location. So those are fundamental concepts to look at. So grade, delivery timing, and delivery location. It is impossible to assert the price of any commodities without having a solid understanding of those three items. Traders in commodity markets seek to generate profit from the movement of prices of commodities. So traders trade various spreads and also trade the flat price or the outright price of a commodity, which has huge influence on almost every other spreads. We have just established that the price of a commodity cannot be established without knowing its grade, its delivery timing, and its delivery location. So in the context of a time spread, what we are seeking to benefit from is a supply-demand imbalance at a given location, but for different delivery timing. In the case of a location spread, we are trying to benefit from supply-demand imbalances between locations for the same commodity. And lastly, we will review a little bit the size of the opportunity. The more uncertain or the more volatile the price differences are, either between locations or the delivery timing, the higher the opportunity is for a trader to benefit and profit from this. First, here's a chart or an animation on the flat price or the outright price of 6 different commodities. The purpose of the animation is twofold. One is to give a sense of the potential volatility that we have for various commodities, which may vary across commodities. And second is to get a sense of how at times they might actually co-move together. So COVID-19 was an extreme example where we saw prices of almost every commodity dropping or falling during that period and increasing thereafter as supply and demand balances reestablished themselves. Time spreads. The picture we have here is for aluminum, and the time spread difference we're looking at is the difference between the front futures contract, so generally for delivery 1 month forward, and the price for the same aluminum at the same location for delivery 6 months forward. Again, we have the COVID-19 period, and we can see that during the worst of COVID-19, what we saw is the price for earlier delivery was significantly lower than the price for later delivery. This is where the economics principles that we first reviewed are important. The context of supply-demand balances. So at any point in time in the current period, supply has to equal demand or be balanced by inventories. When we have a shorter delivery period and we have supply shocks or demand shocks, there is less time for those supply and demand balances to go back to equilibrium. But when we are later in time for later delivery, there is more time for new information to come into the market and for supply and demand to react and readjust to its market equilibrium. Turning to location spreads, again, we stick with aluminum in this case, and the first chart illustrates the premium versus flat price of aluminum for delivery in Europe, US, and Japan. So we can see the variations across time as well as the differences between location. Now, a point to note, going back to economics, is the price delivery or the cost to transport from one location to another may vary a lot depending on the location. So when we look at the size of the differences, for example, the US premium here versus other locations, some of it will be shipping or transportation, but there are other things as well when markets are less perfect. So for example, duties or quotas may also be reflected in those prices. Turning to a different market, the bottom chart shows the prices as a differential to WTI crude of Western Canadian Select, which is the main benchmark crude for Canada. It is a heavy sour crude. And what we have at the bottom of that, the orange line, will show its price at Hardisty, Alberta, which is a production center, effectively Alberta. We consume very little of what is being produced. But as we increment up to the blue line, which is the price in Houston and the Gulf Coast, where refineries are, and it will eventually be consumed and upgraded into refined products, we can see a large spread or economic incentive to actually move the same crude oil from Hardisty, Alberta, to the US Gulf Coast. Now, the size of the spread varies over time and is also a reflection of the supply-demand balances or capacity to transport along the mechanism or pipelines, in this case, in which it will be transported. Risk and uncertainty. How does risk differ from uncertainty? Often we have in academics or practitioners that blur the line between those two. We refer to risk or risk management at pretty much all times. Now, risk is defined in the context where one knows the actual potential states of the world that may occur and its probabilities. If you think about a card game, you don't know what combination of cards you might draw next, but you do know what potential states of cards that you may actually draw. Now, in the real world, we do not know what may actually occur, neither do we their respective probabilities. So literally when we trade, we're actually trading uncertainty, so we do not know. So when we try to assess risk, we try to assess risk in the context of historical views of volatility of the market, as well as forming views going forward. But we do not know what the state of the world might be a day later, 6 months down the road, or 1 year down the road. So everything we do is an assessment. So from now on, whatever we mention risk, we literally mean your uncertainty. So the first aspect around risk or uncertainty is how do we measure it? So a commonly accepted measure for it would be volatility. So generally you might think about the standard deviation of the changes in market price from one period to another. Here we've got 3 different methodologies for measuring it. And the purpose of this slide is to illustrate that although we are trying to measure risk or uncertainty in this case, the choice of measure may impact how we actually measure it. So the blue line is what we would actually do in a general sense by extracting a historical set of data and computing the standard deviation of changes in prices. Now that will return one number, which would be the average over a period. However, when we measure volatility over time, if you think of it where you could actually compute a rolling standard deviation of risk, you might find that risk changes through time. Now this is called heteroscedasticity. So when a trader is engaged in deploying risk or risk capital for the purpose of seeking profit, there's also a risk of a loss. So understanding what the current risk profile will have large impacts on maybe the risk amount that is being deployed or how it is managed in case of losses. Now, this chart represents the flat price of commodity. In this specific case, CL is the contract code for the WTI futures contract on the Chicago Mercantile Exchange. And that's represented by the orange line. The blue line represents the time spread between the contract for immediate delivery or the first delivery the next month, and C2 reflects the second contract. Now, as we can see from this chart, we see that there is somehow of a correlation in the pricing dynamics between flat price going up and the market or the time spread moving into positive territory, and flat price moving down and moving to negative territory. The nature of that dynamics is again rooted in supply-demand balances. Generally, when we have prices rising in the market, so flat price or outright price, we are in a period of strong economic activity. And in that case, prices for immediate delivery will rise above those for later delivery, and that will generate a market that we call backwardated, which is when the blue line is above zero, so a strong market. Whereas in periods of weak economic activities or in recession, the price of commodities will actually drop, and it drops faster for immediate delivery than it does for longer dated delivery. So the opposite of contango, so when the spread C1, C2 is below zero, is defined as a contango market. And we can see in the context of 2008, the crisis 2008, it went fairly negative. Now note on the scale on this one, the C1, C2 spread is scaled by 10. Now, putting it all together in one chart, what we see would be the level of volatility in orange, realized volatility, the time spread, so the C1, C2 in green, and we have the price of the commodity, in this case in blue. So we can see that the periods on the left-hand side, if we look at 2008, 2009 economic crisis, where we tend to see a drop or a fall in the price of the commodity, as well as the market moving into steep contango and high volatility. And as prices move up, it becomes less volatile and the spread returns to more normal levels. And we see the same dynamics occurring with COVID-19 into early 2020, Q1, Q2 2020. Lastly, let's discuss the concept of spot to forward relationship. This is the fundamental principle in finance in terms of no arbitrage. Let's look at it through an example. This shows a forward curve. A forward curve represents the prices as of today for the same grade, same location, but delivery at different timing. So what we have here is the WTI futures forward curve as of the 25th of March 2020. What we represent as the cash is actually the price for delivery in April, which is the first delivery period. And what we have for CLO1 represents the first futures contract listed on the exchange on that day, which in case would be the May period. CL2 with the June, 3, and so on. So we can see in that case what we have a market called in contango because the prices for earlier delivery is lower than that of later delivery. And that creates an economic incentive potentially to store depending on the size of the price difference. Now, the concept of arbitrage and convergence is fundamental in finance or prices. In this specific case, if we observe a potential arbitrage whereby the price for cash delivery or early delivery is lower than the price for forward delivery, in this specific case, it represents the June 2020 futures contract for WTI. If the price difference is above the variable cost of storage, it creates an incentive. The mechanics in this case, because it is a physical contract, and if you hold storage assets, would be as of today to buy the asset, also sell the futures today, lock in the price difference upon delivery of the earlier delivery contract, take delivery, finance it, store it, and upon maturity, deliver it into the futures contract. The chart represents, the red line represents the cash price 2 times. In this case, I went back to 2019. So the cash price is 1 month forward. And the blue line, the futures price, is the price for delivery always for June 2020. So as the price difference between the two moves, the market moves between contango backwardation back to contango in the months prior to delivery. And a trader seeking to benefit and lock in that relationship would actually buy the cash contract and sell the futures contracts on the same day, lock in the price difference. Upon delivery of the cash, store it into tank, finance it, and upon expiry of the futures contract for June 2020, deliver into that contract. That concludes our first video.